we talk about how inflation came in line with expectations, but there's still concerns. Inflation will be stickier than first thought. If you take a look at wages, at rents, that's why the market's pretty nervous.
Exactly right. A little bit of a damp squib overnight in terms of the market reaction, simply because it wasn't as hot as feared. But we're still looking at CPI inflation running at 7% on an annual rate, and going back even 6 months ago, no one was calling that. So we are entering a very different macro paradigm this year relative to last, whereas 2021 was broadly classified as a reflation paradigm for most economies anyway, which is accelerating growth, accelerating inflation, albeit from low bases. 2022 is going to be ushering in a period of much slower growth from our perspective. And our base case at the moment is of easing inflation. But of course, the risk to that view is that inflation remains stickier, logistical bottlenecks remains with us for a lot longer than anticipated. And therefore, inflation stays at uncomfortable levels for much longer than most expect, including our esteemed central bankers, which is another way of saying, and a long way of saying, that stagflation is the concern, and that is a much more challenging backdrop for risk assets.
2021 was about Tina. There is no alternative, 2 stocks. Is it the same story in 2022?
It is to a degree, but given the more challenging macro regime facing the market, we would advocate more of a barbell strategy. So that favours more defensive quality growth, such as consumer staples, big tech, healthcare. There's a place in portfolios for those, balanced with a value profile as well, where we're more focused on cash flows being stable, where dividends are safer. Select utilities, for instance, fall into that category. In terms of the Asia region in which we sit, when we run the macro screen for 2022, it's much more of a mixed bag. We do like ASEAN, we like Taiwan, and we do like Japan as well.
You mentioned that headwinds could include stagflation. Surely that's off the table now.
How so, Rish, when you're confronted with multiple photos? Every time I wake up in the morning, someone's sending me photos of their supermarket shelves being completely bare. The on-the-ground reports from those in logistics suggest that we do need to worry about the potential for supply bottlenecks sticking around for a lot longer, certainly well into the second half of this year. It's not our base case, of course, but we need to be aware of the risks to that base case, and that's certainly where we're seeing those risks tilted at the moment, especially if you look at COVID. While we're seeing great news in the fact that it seems to be a lot less severe in terms of the symptoms, fatality rates are a lot lower than previous waves. We have to balance that against the fact that economies are starting from much lower bases. We have much less policy headroom, and not to mention the fact that the supply chain disruptions over the last 18 months to 2 years, incredibly severe. What has that taught governments? It's taught them to move away from just-in-time supply chains to just-in-case chains, if not just for me in some cases.
Yeah, and of course, your call on the dollar is going to be vital here. And what about how it affects the majors, and what about the way that it affects some of these emerging market currencies, especially those which have a lot of offshore debt?
Great point, Rish. I'll give you 2 sides of the coin in terms of the big dollar view. A more negative case, and we certainly saw the knee-jerk reaction overnight to CPI out of the US as one of a negative reaction for the US dollar. But that was largely because inflation wasn't as bad as feared. It was very short term. The market has got a lot priced in for the Federal Reserve. We're talking about 4 hikes when it was 2 or 3 not that long ago. So where are we going next? Who knows? But that is a very aggressive profile for the Federal Reserve's monetary policy for the next year. And we doubt they will be able to follow through with that. And so from that perspective, it does seem like a lot is priced into US dollar strength. I would balance that against the fact that we are seeing a major withdrawal of global liquidity. Typically, that favors safe havens, favors the likes of the US dollar, and the biggest losers in that environment are the emerging market currencies. But again, we would really stress that a much more differentiated approach to emerging markets is the right way to go. It's not a homogenous asset class.